As of this moment, with live trading fully underway, AMC Entertainment stock is priced at $2.86, showing an intraday gain of 1.78%. Many traders looking at this ticker on their Robinhood or SoFi Invest accounts will see this modest green candle and perhaps feel a glimmer of the old excitement, the expectation that this battleground stock is gearing up for another unpredictable surge. But the reality staring back from the institutional-grade terminals, the kind used at major firms offering services like Fidelity Wealth Management or on platforms like Interactive Brokers, tells a story that is infinitely more complex and, frankly, far more precarious. The raw truth is that a sub-2% move on a stock this notoriously volatile is less a sign of strength and more a portrait of profound indecision in the market. While the retail narrative remains fixated on short squeezes and fighting Wall Street, the deeper reality is that AMC is currently locked in a desperate struggle with its own balance sheet, a reality that today's minor uptick does little to alter. The common belief, the persistent expectation fostered in online forums and social media threads, is that AMC's fate is a David and Goliath saga. It's a story of a beloved company, the place of first dates and blockbuster summer nights, defended by a loyal army of retail investors against predatory short sellers. This narrative has fueled incredible moments of defiance and has certainly inflicted pain on hedge funds who underestimated the power of collective retail action. It's a powerful and compelling story. However, the market's current reality is less about an epic battle and more about a slow, grinding war of attrition against fundamental economic pressures. The expectation is for fireworks, the reality is the methodical dripping of a faucet. Today's trading volume, for instance, is tracking significantly below its recent averages. Low volume on an up day often suggests a lack of conviction. It's not a broad-based buying frenzy, it's a quiet drift upwards, suggesting the big players, the institutional funds that truly move markets, are largely sitting on the sidelines, watching and waiting. They aren't convinced, and that should give any investor, whether managing a Schwab Intelligent portfolio or self-investing on a mobile app, a serious reason to pause and look beyond the surface-level green arrow. Digging into the recent stock movement reveals a concerning pattern. Over the past month, despite a few flickers of positive momentum, AMC stock has been in a clear downtrend, bleeding value slowly and steadily. This isn't the dramatic cliff dive that captures headlines, it's a persistent erosion of confidence. The stock has been struggling to hold key technical support levels, and each failure to mount a significant rally above resistance brings out more sellers. Institutional filings tell part of this story. While there are some funds holding or even slightly adding to their positions, a significant portion of the smart money has been reducing exposure. They see the mountain of debt the company carries, a legacy of aggressive expansion followed by a crippling global pandemic, and they see the immense challenge of servicing that debt in a higher interest rate environment. The company's recent earnings report, while showing some year-over-year revenue improvement thanks to a better film slate, could not mask the fact that profitability remains elusive and shareholder dilution has been substantial. The issuance of new shares, a necessary evil to raise capital and stay afloat, has continuously diluted the ownership stake of every single investor, a mathematical reality that often gets lost in the excitement of the meme stock narrative. Comparing this to the consistent profitability of giants like Apple stock or the explosive growth of Nvidia stock, the contrast in fundamental health is stark. For those unfamiliar with the core business, AMC Entertainment is the largest motion picture exhibitor in the United States, in Europe, and throughout the world. Its business model is straightforward. It operates thousands of movie theaters, generating revenue primarily from ticket sales, admissions, and secondarily, but with higher margins, from food and beverage sales, concessions. The expectation was that with the pandemic in the rearview mirror and a slate of blockbusters returning to the silver screen, the business would roar back to its former glory. The reality is that the landscape has been permanently altered. The theatrical window, the exclusive period theaters have to show a movie before it moves to streaming, has shrunk dramatically. Competition from high-quality home entertainment is fiercer than ever. While people are indeed returning to theaters for major event films, the overall frequency of moviegoing for mid-tier films has not fully recovered to pre-pandemic levels. This puts immense pressure on AMC's ability to generate consistent cash flow, which is the lifeblood needed to pay down its billions in debt and lease obligations. Past performance shows a company that has been fighting for its life, undertaking complex financial maneuvers, including the creation of the AP preferred equity units and subsequent reverse stock splits, all in an effort to maintain liquidity and stave off the worst-case scenarios that analysts at major investment firms have modeled out. Comment below with your honest opinion. Do you believe the movie theater industry can ever fully recover to its pre-streaming era strength, or has consumer behavior shifted for good? Looking toward the future, the outlook for AMC is a tapestry of significant opportunities woven through with existential risks. The primary catalyst and the bull case for the stock hinges on the box office. A string of mega hits could drive revenue and, more importantly, high-margin concession sales, generating the cash needed to make a meaningful dent in its debt. The company is also exploring alternative content, such as broadcasting live concerts and sporting events to draw audiences during weaker film slates. There is potential in these ventures to diversify revenue streams. Furthermore, any sign of the Federal Reserve lowering interest rates could provide significant relief, making it cheaper for AMC to refinance its debt obligations. This is the future the retail bulls are betting on, the expectation of a perfect storm of blockbuster movies and favorable economic winds that allows the company to not just survive, but thrive. This is the core of the online investing thesis for many who use Fidelity or other online investing sites for self-investing. However, the reality is that the risks are equally, if not more potent. The most significant risk remains the overwhelming debt load. It is a constant drag on the company's financials, siphoning away cash that could be used for theater improvements or other growth initiatives. The threat of further shareholder dilution is also ever present. If the company faces another cash crunch, issuing more stock is one of the few levers it has left to pull, further diminishing the value of existing shares. Another risk is the Hollywood pipeline itself. Production delays, actor strikes, or a slate of films that simply fails to resonate with audiences could quickly derail any recovery. An economic recession would also disproportionately harm AMC, as moviegoing is a discretionary expense that consumers cut back on when budgets are tight. The expectation is a cinematic comeback story, but the reality is that AMC is walking a financial tightrope, where a single misstep or an unfavorable gust of macroeconomic wind could have severe consequences. This is the tension that defines the investment. It isn't just a simple bet on movies, it's a high-stakes wager on financial engineering, consumer habits, and the company's ability to navigate a treacherous debt landscape, a far cry from the more straightforward growth stories of something like Tesla stock. In summary, the story of AMC Entertainment stock today is a masterclass in the divergence of expectation and reality. The live price of $2.86 with its small intraday gain offers a deceptively calm surface. Beneath it lies the turbulent reality of a company whose popular narrative as a retail-driven cultural phenomenon is at odds with its challenging fundamental finances. The expectation is for a short squeeze, for a dramatic victory against the Wall Street establishment. The reality is a protracted struggle against billions of debt, shifting consumer habits, and the relentless mathematics of share dilution. While the passion of its investor base is undeniable and provides a unique and unpredictable variable, the path forward is dictated less by sentiment and more by the cold, hard numbers on its balance sheet and income statement. The ultimate fate of this investment will be decided not in the forums, but in the company's ability to generate sustainable free cash flow. That is the fundamental reality that will, in the end, always triumph over expectation.